Hello and welcome to the out of class segment video on country evaluation, selection and foreign market entry strategies. In the previous lecture, we talked about how a nation's competitiveness can be measured, which equips the marketer or a businessman to take the basic foreign market entry decisions. So, a firm that intends to expand in the foreign markets must make the decisions like which markets to enter, when to enter into these markets, what should be the scale of entry, and which is the best mode of entry. We shall now be talking about all these decisions in detail one by one. So the first thing that has to be decided by a business manager is that which markets to target. There are approximately 200 nation states in this world. So which market could be the most suitable one to enter into? For this, there are certain factors that have to be considered. First factor is the nation's long-run profit potential, which can be assessed by several sub-factors like the size of the market in terms of the demographics, the present wealth of the consumers in that market in terms of the purchasing power of the customers, and the likely future wealth of the consumers, which depends upon the economic growth rates and the living standards. Another factor that can be considered is the nation's competitiveness in the world economy, which can be known by going through various reports that have been published by different agencies, and the most common one being the Annual Global Competitiveness Report published by World Economic Forum, which takes into account the 12 pillars of competitiveness. Now, there is another important factor, which is the value that an international business can create in a foreign market. And that value depends upon the suitability of its product offering to that market and also the nature of indigenous competition in that country. If the international business can offer the product that has not been widely available in that market and satisfies an unmet need, the value of that product to the consumer is likely to be much greater than if the international business offers the same type of the product that is already being offered by others. So, to sum up, if we have to choose our target market from say 200 nations, we can assess them initially on the basis of political and economic situation. We can then assess the remaining countries on the basis of market attractiveness and the level of technological development. Then on the basis of market forces like demand and supply. And finally, we can rank the countries on the basis of companies, resources, and select the most suitable country as a target market. The second decision that an international business manager might have to take is the timing of entry. Whether you want to become an initiator, the early entrant, that is the first mover, or you want to be a late entrant. If the firm becomes the early entrant, that is, it enters the foreign markets before other firms, they are able to capture the first mover advantages like the ability to preempt rivals and capture the demand by establishing a strong brand name, then the ability to build sales volume, and the ability to create switching costs that tie the customers into products and services. However, there can be disadvantages also associated with the first movers, and a primary disadvantage is the one that the company has to bear in terms of the pioneering costs. Like, the firm has to devote considerable time, effort, and expense in learning the rules of the game. Then there are certain mistakes also which the company can commit due to ignorance. Then a certain liability is associated with being a foreigner, since you are the first entrant and that in that market and the customer might not accept you. And the pioneering costs also include the costs of promoting and establishing a product offering, including the costs of educating the customers. So the firm has to consider all the costs and benefits associated with the timing of the entry and make the decisions accordingly. Now, another issue that an international business needs to take up is the scale of the entry. Whether you want to invest at a large scale or at a small scale. Entering a market on a large scale involves a commitment of significant resources and it also results in rapid entry. This will have several effects. On the positive side, it will make it easier for the company to attract the customers and distributors, and the company is likely to capture the first mover advantages. On the negative side, the decisions become difficult to reverse as you have invested a lot of money, and it can also limit the strategic flexibility. Whereas, on the other hand, the risks of large-scale entry are the benefits of small-scale entry. Small-scale entry allows a firm to learn about a foreign market, and it also limits the exposure of a firm to that market. But at the same time, the lack of commitment associated with the small-scale entry has certain disadvantages also, like it may make it more difficult for the small-scale entrants to build the market share and also to capture first-mover advantages. So we can say that it again depends upon the firm and its risk-taking ability, that whether it should go for the large-scale or a small-scale investment. The next decision that a firm has to take is the mode of entering into foreign markets, and there are a number of options available to enter into the international markets, like exporting, licensing and franchising, strategic alliances, joint ventures and consortia, and also foreign direct investment. Now it again depends upon the firm's risk-taking ability and the degree of control that it wants to exercise over its investment, that which entry mode will it select and will be the most suitable one. So in order to sum up, we can say that there are no right decisions, just the decisions that are associated with different levels of risks and rewards that the firm can decide upon, that which markets should be targeted upon, the timing of the entry, the scale of entry, and the mode of foreign market entry. Thank you.